Hi, it's Dre Griggs with Obsidian Wisdom. Today we'll be discussing inflation versus the stock market. When it comes to figuring out your investments, when you're trying to figure out what type of income can I build, is it safe to put my money in investments, what investments should I put it in, you've probably been asking the question, at least more recently, about inflation and how that impacts your stocks. Because we're in a period of time where inflation is really, really high, and people are starting to get very concerned about it, where cost of goods are going up significantly. We're in times where we said that inflation is higher than it's been in the last 30, 40 years. As far as the economic cycle, inflation is often going to be seen with economic booms. When growth is happening at such a rapid rate, people are feeling really good, people are spending more money. As a result, you end up having a lot of money going towards fewer goods. And so if you have a business, how you then differentiate your product, or how do you make sure you don't run out of inventory all the time, you increase the price of your inventory. Now, that's not always the reason that inflation comes about, but I can say that more times than not, inflation does come around during times of high economic growth. And so if you are just sitting back and you're saying, okay, what should I do at this time? Should I continue investing in stocks? Should I wait it out a little bit? Should I see where we're going to go? Let's talk about a few things to help you make that decision. First and foremost, the studies have shown that there are times where inflation helps your portfolio. There are times where inflation doesn't help your portfolio. Now, if you are investing in a growth company, a company that is maybe a little bit younger and is growing at a rapid rate, they're usually investing money back in their business. Now, when this happens, sometimes that money is all from their profits. In that case, then you don't have as much to worry about, because all of the money is going to be coming from money that's already taking inflation into consideration, assuming that they've raised their prices with inflation. Now, it's fair to say that that doesn't happen immediately, because you don't want to give sticker shock to your customers. So more times than not, it's usually over a few quarters that you'll see small increases in the rate. And so maybe at the very beginning, it will be very damaging on the company's bottom line, because they can't pass on their higher cost to the customer just yet. But it does, over time, end up being kind of baked into the cake. And so from that standpoint, having your money in the stock market is a good decision, because it already is going to take inflation into consideration. So you should at least see a growth of your stocks of at least 2 to 3% to keep up with inflation. Just simply, that company keeps all of their money the same, and they're just increasing with inflation, well, then their stock should grow by 3% every year. Now, you may want to keep track of something that's called the real growth rate, and that is where you subtract inflation from the amount of growth that a company's had over the year, and that may be a better way for you to manage and decide, is this really making sense for me, or is this a bad investment? Now, on the other end, if it is a growth company that is borrowing money, well, as you've seen even in this current economic climate, more times than not, when inflation gets really high, the Fed ends up increasing interest rates because they're trying to slow down the inflation. And so if that's happening, then money becomes much more difficult for a growth company to access, or at least the cost of that money is much higher. And so it makes it a little bit harder for them to expand and grow their company. And as a result, it can negatively impact the growth of that company. If the company is going around, let's say a company in the past 2 years when rates were historically low and at like 0%, well, that company was getting money almost for free. So they're getting free money and turning it around and making a profit. So they were growing exponentially. Now that we're increasing the interest rates, they've gone up about 0.5%, and they plan on increasing it even more. Well, now that company is going to have to pay much higher interest. And so they may not be able to get as much money as they would have, because it changes the payment, it changes the terms, it changes everything around. So as a result, you may not want to invest in a growth company. Now, on the other hand, if you're looking at stocks that we would consider value investments, these are normally going to have high cash flows. As a result, they're not really as concerned in getting loans. So they tend to do just fine, where all they have to worry about is passing on the higher cost to their customers, and as a result, they're going to have a higher profit, and then their stocks are going to go up. And again, you'll probably want to look at the real rate of return just to make sure they're not just baking in a lot of inflation. But as a result, you tend to see that value investments, that those type of companies tend to do a lot better, because they don't need the loans. They're not really trying to exponentially grow. They have large cash piles. They're really trying to work and navigate the their consumer base and the market and increase market share. So they just have a different vision, and that vision works pretty well in inflation, so it doesn't impact it negatively. Now, again, when we first start with inflation, because inflation, it could be considered a people's tax. What I mean is it's where if you were able to spend $10 on something and get it today, and then maybe tomorrow you have to spend $12 on something because maybe the government is printing a ton of money, instead of them just increasing your taxes, right? Instead of them just saying, you know what, we have to balance our budget, so we're going to increase taxes by like 15%. And now we're able to balance our budget and everything's going to be okay. Instead, they just keep printing the money, but it ends up creating the inflationary environment, which then is a tax on you and me indirectly because we have to spend more money to buy the same products. So it's almost the exact same where we are now paying what could be equatable to a higher tax rate. And so that's why inflation is really damaging to an economy in the early goings. But if it's going to be in the environment where inflation is because there's exponential growth, the economy is doing really good, well, that feels a little bit different than inflation is because we're just printing a bunch of money. Now, our current economic climate, we have a little bit of both. We have a lot of money being printed. We have a pretty good economic environment. We have the coming out of the pandemic. So as a result, our money and the goods, everything's kind of being like tied up together where it seems like we have empty shelves all the time. So companies are saying, okay, well, people are willing to pay more because I have less. And so companies end up increasing the price. And then if you look at like the housing, what's going on with housing, I mean, if we really look across the board, we've seen it with automobiles and used cars where people want used cars, but there's not that many, so they have to increase the prices. Or some of the goods to build houses, there's not as much, so we had to increase prices. So you see it's tied a lot to economic growth, but then you also know on the other end where we just stopped the quantitative easing, which is a very fancy way of saying that the Fed was printing and putting billions of dollars into the economy to keep it afloat. We also were dealing with near 0% interest rates. So you had the environment where we are also spending a ton of money. And so now we're trying to rein things back in and things are starting to slow down where houses aren't doubling and tripling in value as much as they were, where rent and different prices of things are going up and people are spending a little bit less. And so we see that we're starting to slow down to the point that people are starting to worry about a recession. Now, on the one end, obviously we don't want a recession, but on the other end, that's what happens after an economic boom. If you look at the seasons, right, we go from winter to spring, and then we go from spring to summer, and summer to fall, and then fall to winter, right? That's the seasons. That happens all the time. From an economic standpoint, it's the same thing. You have economic growth, and then you peak, and then you start to slow down into a recession, and then you hit like a trough, so it bottoms out. And then it starts to grow again, and we call it economic growth. That is the seasonal cycle of our economy. So it has to go from a boom to a peak to a slowdown, which leads you to a recession. And if it keeps slowing, it would be like a depression. But that is our economic cycle, right? We can't always be in a recession. We can't always be in a boom. So when it comes to your stocks versus inflation, it really depends where your money is at. But on the one end, inflation is built into the money. We're going to take inflation in consideration when we value a company. Where if it takes more money today, that amount of money is going to be accounted for in the valuation of the company. So if you're buying certain stocks, then you should feel okay because inflation is already baked into the cake. I put my money in, everybody else puts their money in, we're assuming that this company is worth more, and a part of that is the higher cost that they are charging because of inflation. On the other end, if you have a company that is growing and taking loans and then the money is more difficult or more expensive for them to get, well, that may negatively impact that company, which would negatively impact your overall portfolio. So you really want to take into consideration, am I investing in value or am I investing in growth? And is my company positioned well in inflationary times, or is it something that people will buy less of because it becomes more expensive and their money goes to less places, so they have to cut back on what they're spending on? These are all questions that you want to consider when you're answering that question. Now, if you have any additional questions about retirement, you know I'm here for you. You can reach out to me at obsidianwisdom.com. If you want to have a demo of the Wisdometric framework, you can go to obsidianwisdom.com/training. And in it, I give you the entire Wisdometric framework that I use with my clients to help them eradicate financial stress, generate passive income, and build a prosperous retirement strategy. Hey, until next time, Wisdomites, remember, wisdom is asking the right questions to allow yourself to get the right answers. Keep asking those questions and you will keep getting those answers. Continue blessings.